What exactly is an investing pre-mortem, and why would it be helpful if you had one?
Make Better Wealth Decisions, a podcast that explores how financial advisors' blind spots can harm your investments. I'm your host, John DeGuy, a portfolio manager with Design Securities in Toronto. In this podcast, we'll provide advice on how you can achieve better outcomes by maximizing investments and minimizing taxes. Let's put our thinking caps on as we consciously decide to get smarter about our money.
Last week, we had a guest who was an expert with regard to behavioral finance who talked about how we could actually apply things that are academic in a consulting sort of perspective. This week, we had not one, but two guests who are experts in a different sort of way, in a more of a real world fashion. One has a 30-year background in sales and advertising, and the other has a 30-year background in personal finance and product manufacturing and advocacy and regulation. We talked this time about how you might want to do a pre-mortem. So last week, we talked about having an investing constitution, something that is written that you can refer to. A pre-mortem, on the other hand, is where you stop and you purposefully think about what you might be doing and how you might react if markets, for whatever reason, took a turn for the worse. Now, this is the sort of thing that a lot of people don't really ever contemplate. What if things went wrong? Most people think about, oh, don't worry, life will be fine. And they have a wonderful vision in their head of how everything will turn out beautifully and there will not be any problems. The real world, of course, is rather different. Things oftentimes don't go the way you would want, the way you would expect. And the question then becomes one of, well, since we know that things don't always go the way we expect, why didn't we expect things? Why didn't we at least think about what we might be expecting? So that's what a lifeboat drill, and more specifically a pre-mortem, involves. A pre-mortem is where you actually write down what went wrong. What did I miss? If you stop and think about, maybe I didn't think about hedging my portfolio because I have foreign assets. Maybe I didn't think about what could go wrong and how my conservative bonds could lose money if we have a run-up in rates, such as what we had in 2022. What if there are any number of things? What if you don't think about valuations and, oh, geez, the stock market's doing well, but it's because valuations are very high. And how would I react if valuations came back down to traditional levels, but that means maybe half of what they are currently? And if the way you get down to valuations that are half is by bringing the market price down by half, that's the sort of thing that you would probably be pretty uncomfortable about. So to what extent do you stop and think and memorialize, actually write down what you will do if in fact things don't go well? And specifically, what have you done to purposefully contemplate what might go wrong before you buy a product or pursue a strategy? For instance, let's say you've got a wonderful idea on a penny stock that you want to buy, and you've got a lot of TFSA room, and you think this is fantastic. My $7,000 TFSA investment is going to go to the moon, and when it goes to the moon, I can sell it, and I won't even pay tax on the capital gain because it'll all be sheltered in my TFSA. What if that $7,000 investment goes down to zero and now you've lost the full $7,000? And what is worse, you can't even claim the capital loss because capital losses can be claimed in taxable accounts, but not in TFSAs. TFSAs, the good news is you don't pay tax on the capital gain. The bad news is you don't get to claim the capital loss on a capital loss. Things like that are the sorts of things that many people don't really reflect upon before they act. And it would be useful if before you make a major investment decision, especially if it is off the beaten path, if it's just another small addition to you got your tax refund and you got to top up your RSP, that's one thing. It'll be done on the margin. It'll be 1 or 2% of your net investable assets. That's one thing. But if in fact you're going to make a major decision to change your portfolio in a major way, before you make that change, it would be really helpful for many people if you stopped and contemplated what might go wrong. A lot of problems can be headed off in the past by simply thinking about what could go wrong, and then perhaps, if necessary, changing your decision about what to do going forward. We'll see you soon.
John DeGooey is a portfolio manager with Design Securities in Toronto. The views expressed in this programme are not to be construed as specific advice. It is recommended that you consult a qualified advisor before taking action. His books, The Professional Financial Advisor 4, Stand Up to the Financial Services Industry and Bullshift are available through Amazon and in bookstores throughout Canada. You can reach John at 647-STAND-UP. That's 647-782-6387 or at jdegooey@designedsecurities.ca.